TOST, the restaurant management and payments platform serving 171,000 restaurant locations with point of sale, online ordering, payroll, and embedded financial services built for the food service industry.
FY 2025 revenue $6.15 billion. Q1 2026 revenue $1.63 billion, up 22%. Adjusted EBITDA $179 million.
TOST was founded in 2011 in Boston, building a cloud-based POS system specifically for restaurants at a time when generic retail POS software was failing to serve the unique workflows of table service, quick service, and bars.
TOST launched its payments network in 2014, embedding financial services directly into the restaurant workflow.
TOST went public in September 2021 at a $14 billion valuation. By 2026, the platform serves 171,000 restaurant locations.
Fintech solutions, primarily payment processing, generate approximately 70% of revenue.
Subscription services contribute approximately 25%. POS software, payroll, scheduling, and marketing tools billed as recurring SaaS. Hardware and installation generate the remaining 5%.
FY 2025 revenue $6.15 billion. Annual recurring revenue $2.2 billion, up 26%. Gross payment volume $51.3 billion.
Q1 2026 revenue $1.63 billion, up 22%. Adjusted EBITDA $179 million. FY 2026 adjusted EBITDA guided $790 to $810 million.
Square for Restaurants competes in the SMB and quick service segment, broader platform but less restaurant-specific depth. Lightspeed and Aloha by NCR compete in table service and enterprise restaurant chains.
Spot On targets mid-market restaurants with competitive pricing. None has matched TOST's restaurant-specific feature depth and location count.
TOST's moat is the restaurant-specific integration. Every module from inventory to payroll to loyalty is built for food service workflows, creating switching costs that generic POS and payments platforms cannot replicate.
TOST operates across the United States as its primary market, with 171,000 locations spanning quick service, table service, bars, cafes, and enterprise chains from single-unit independents to national brands.
International expansion is in early stages. Canada and United Kingdom are initial markets. TOST IQ, the AI agent for restaurant operators, launched in 2026 to drive digital marketing and demand generation across the platform.
Aman Narang co-founded TOST in 2011 and became CEO on January 1, 2024, previously president and co-leading go-to-market alongside founder Steve Fredette as the company scaled from startup to public company.
Narang holds a degree from MIT. Under his sole CEO leadership, TOST accelerated EBITDA toward profitability. Q1 2026 net income of $126 million.
TOST, the restaurant management platform, $6.15 billion in FY 2025 revenue, serving 171,000 restaurant locations with payments, software, and AI tools built exclusively for food service.
Q1 2026 revenue $1.63 billion, up 22%. Adjusted EBITDA $179 million. Net income $126 million, more than double prior year. FY 2026 adjusted EBITDA guided $790 to $810 million. TOST's profitability inflection delivered.
The restaurant industry is one of the largest and most complex sectors in the American economy. Approximately 1 million restaurant locations, over $1 trillion in annual sales, and historically one of the most underserved by purpose-built technology. For decades, restaurant operators ran on cash registers, paper tickets, and disconnected accounting systems. TOST has spent 10 years building a vertically integrated technology platform, point of sale, kitchen display systems, online ordering, payroll, scheduling, inventory management, and small business lending, specifically for restaurants. The result is that TOST now processes over $100 billion in annualized gross payment volume across over 120,000 restaurant locations.
Revenue for Q1 2026 came in at $1.63 billion, in line with the $1.632 billion estimate, and up 24% year over year. Earnings per share of 29 cents beat the 28-cent consensus. The year-over-year revenue growth reflects continued net new location adds, management guided to approximately 8 to 10,000 net new locations per quarter, combined with expanding financial services revenue as Toast Capital, the embedded lending product for restaurant operators, generated its highest quarterly origination volume. The gross payment volume per location also increased, reflecting both menu price inflation and higher digital ordering penetration at existing customer locations.
CEO Aman Narang co-founded Toast and took over the CEO role in 2022 after co-founder Chris Comparato transitioned to a board role. Narang's background is in product and engineering, and his leadership style has been characterized by rapid product iteration and a focus on deepening the platform's value proposition for existing restaurant customers rather than purely focusing on net new location growth. The strategy reflects Toast's belief that the largest revenue opportunity lies in expanding ARPU, average revenue per location, from the current approximately $14,000 annually toward $30,000 to $40,000 as more financial services products achieve high attach rates.
Toast Capital is the financial services product that has the most significant near-term impact on Toast's revenue trajectory. The product is a revenue-based lending tool that allows restaurant operators to borrow against their expected payment card volume, which Toast processes, with repayment automatically deducted as a percentage of daily card sales. For restaurant operators who struggle to obtain traditional bank loans due to limited collateral and income volatility, Toast Capital is a compelling alternative. Origination volume grew approximately 42% year over year in Q1 2026, and the credit performance of the loan book has remained within expected loss rates.
The attach rate of Toast's non-POS products is the key variable driving ARPU expansion. When a restaurant first adopts Toast for point of sale, that is the anchor product. Toast then cross-sells payroll processing, marketed as Toast Payroll, scheduling and HR software, the Toast Capital lending product, and Toast for Enterprise capabilities for multi-location operators. The payroll attach rate among Toast-installed restaurants is approximately 30%, up from approximately 20% 2 years ago. Management estimates that each percentage point of payroll attach rate improvement adds approximately $20 million to annual recurring revenue across the installed base.
The competitive landscape for restaurant technology has become more crowded as Toast's success attracted attention from larger incumbents. Square for Restaurants, part of Block's portfolio, has made significant investments in its restaurant-specific POS capabilities. Lightspeed, the Canadian POS company, has a hospitality product that competes in the full-service restaurant segment. Oracle Hospitality serves large hotel and resort restaurant operations. However, none of these competitors has replicated Toast's fully integrated cloud-native platform specifically designed for U.S. restaurant workflows. Toast's product depth, particularly in kitchen operations and back-of-house management, remains a meaningful differentiator in the mid-market restaurant segment.
International expansion is the growth frontier that Toast has only begun to explore. The company opened its UK market in 2024 and has piloted in Ireland and Canada. International markets present a different regulatory and payment infrastructure environment, VA compliance, different card network rules, local payroll regulations that requires significant product localization investment. Management has indicated that international locations account for less than 5% of total installed base as of Q1 2026, but has guided for a meaningful acceleration of international location adds through 2027 as the UK product matures and new markets are entered.
The enterprise segment, multi-location restaurant chains with 50 or more locations, is a strategic priority that requires a different sales motion than Toast's traditional mid-market approach. Enterprise contracts involve longer sales cycles, custom integrations with third-party kitchen systems and loyalty platforms, and dedicated customer success teams. Toast has built an enterprise-specific sales force and product team over the past 2 years, and management cited enterprise as the fastest-growing segment by location count in Q1 2026. A major national chain win would provide both revenue and brand validation that accelerates future enterprise sales cycles.
The path to sustained GAAP profitability remains a watch item for Toast investors. The company has been consistently improving its operating margin. Q1 2026 non-GAAP operating income was approximately $120 million, representing a 7.3% margin, but GAAP profitability has been elusive due to stock-based compensation expense. Management has committed to achieving GAAP profitability on a run-rate basis by the end of 2026, which would be a meaningful milestone for a company that has consumed over $3 billion in cumulative cash since its founding. The balance sheet is solid, approximately $700 million in cash, but the GAAP profitability milestone matters for institutional investors with restrictions on non-GAAP only holdings.
Key metrics to watch at Toast. Net new restaurant location adds versus guidance of 8 to 10,000 per quarter, Toast Capital origination volume and credit loss rate, payroll attach rate progress, and any updates on international location add pace. A payroll attach rate crossing 35% would be a significant signal that ARPU expansion is compounding, and an international announcement of a major market entry would expand the addressable market narrative meaningfully. Toast Capital is the unit within Toast's platform that deserves significantly more investor attention than it currently receives. The embedded lending product offers working capital advances to restaurant operators based on their real-time sales data flowing through the Toast system. Because Toast processes every transaction, it has a level of insight into a restaurant's cash flow predictability and seasonal patterns that traditional lenders can't access from conventional financial statements. This information advantage allows Toast Capital to price risk more accurately and lend to profitable operators who might otherwise be underserved by community banks. Toast Capital grew 42% year over year in the most recent quarter, making it one of the fastest-growing components of the platform.
The enterprise restaurant expansion is a meaningful strategic initiative for Toast, as it looks to extend beyond its core small and mid-size restaurant base. Enterprise chains have historically been served by legacy point-of-sale systems from vendors like NCR and Aloha that offer stability but lack the cloud-native architecture and open API ecosystem that modern operators demand. Toast has been investing in its enterprise product, building out the multi-location management tools, corporate reporting, and franchise support features that large chains require. Several enterprise logos have been announced in the past 12 months, and management has indicated the enterprise pipeline has grown substantially as legacy vendors face increasing competitive pressure from Toast's platform approach.
The path to profitability at Toast is straightforward to model, even if it requires patience. The company generates positive gross profit on its payment processing and software subscription revenue, and the fintech services segment, including Toast Capital, contributes incremental high-margin revenue at scale. The drag on operating income is primarily sales and marketing investment to acquire new restaurant locations and R&D spend on platform expansion. As the installed base grows and churn remains low, the revenue from existing customers increasingly covers the fixed cost base. Management has guided for positive adjusted operating income on a sustained basis, and analysts who focus on gross profit per location trends see the trajectory as achievable within the current plan horizon. Everything on Charged Alpha is financial education and analysis, not personalized investment advice. Past performance does not predict future results. Always do your own research, understand your risk tolerance, and speak with a qualified financial advisor before making investment decisions.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.